Would you like to get the scoop on an underloved and underfollowed dividend stock yielding almost 5%? Want to buy into a business that just announced an exciting merger that could bring about huge upside? Like the idea of collecting safe dividend income that's more than twice as high as what the market offers? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a regional banking institution that's been providing valuable community banking products and services for over 150 years. Bank stocks have been beaten up throughout 2020. Low interest rates and business shutdowns are not exactly a recipe for banking success. However, banks like this one that have passed unprecedented stress tests have proven themselves as rock-solid institutions. And they just announced an exciting merger that could make them a regional powerhouse and unleash a lot more growth. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Huntington Bancshares Incorporated, which appear to be trading at a significant discount today. Huntington Bancshares Incorporated, stock ticker HBAN, is a regional bank holding company that offers a range of traditional banking services such as deposits, auto financing, mortgages, and insurance products. Founded in 1866, Huntington is now a $12 billion by market cap major Midwest player that employs almost 16,000 people. Huntington operates over 800 branches, which are located in the American Midwest region. Their core market is Ohio. They rank third in deposit share in Ohio, holding 15% of the state's deposits. 2020 has been a tough year for bank stocks. A combination of a pandemic and low interest rates have challenged banks like never before. But I think this year has been a blessing in disguise. The Federal Reserve has stress tested U.S. banks this year using stricter requirements than ever. In an unprecedented move, the Fed has actually tested banks twice this year, and the banks have been largely passing with flying colors, with buybacks back on again. Furthermore, and more to the point, the pandemic has been in and of itself the biggest stress test you could possibly imagine. Real life has trumped even the toughest regulator. Again, US banks have held up remarkably well. If there were any doubts before about the strength of US banks, there shouldn't be now. 2020 has also been a year of acceleration. Trends that were already playing out before are speeding up. One of those trends is consolidation within banking, especially among smaller regional banks. With low interest rates making it more challenging to make money in traditional banking, scale has become more important than ever. Recognizing this challenge and taking advantage of the environment, Huntington recently announced a merger with fellow Midwestern bank TCF Financial Corp. The transaction is expected to close in the second quarter of 2021. This move will see the two organizations combine and become a top 10 regional bank with approximately $135 billion in deposits. This is instant scale, giving the bank even more headroom to move out nationally, increase its market position, and improve digital capabilities. Due to an overlapping footprint in the Midwestern region, Huntington, which serves as the acquirer and will retain its name post-merger, sees room for significant synergies. We're talking 37% of TCF's non-interest expense. While it'll take time to flesh out, this move could end up being a tremendous win for the combined enterprise. Huntington expects the transaction to be 18% accretive to 2022 earnings per share. That kind of accretive growth would give them even more firepower for dividend raises, which obviously bodes well for shareholders. Huntington has already increased its dividend for 9 consecutive years. The 5-year dividend growth rate is an astounding 23.3%. While dividend raises are currently on pause due to the coronavirus situation, I fully expect Huntington to get back to raising the dividend once more in 2021. And with the new and improved Huntington emerging next summer, precisely as we're moving past the virus, this could be a 1-2 punch to get the dividend moving aggressively again. This dividend growth potential comes on top of the stock's yield of 4.8%. That yield is more than twice as high as the broader market's yield. It's also 180 basis points higher than the stock's own 5-year average yield. The payout ratio is high at 84.5%, 5%, but this is more of a temporary blip than a sign of long-term trouble. US banks, including Huntington, started to set aside reserves earlier in 2020, which had the effect of reducing earnings. Releasing reserves will cause earnings to rebound. For perspective, this bank has typically sported a payout ratio between 20% and 40%. I believe they'll get back to that level soon enough. These are really solid dividend metrics, and I think the dividend will look even better next year. Looking at business growth, Huntington grew its revenue from $2.674 billion in fiscal year 2010 to $4.667 billion in fiscal year 2019. That's a compound annual growth rate of 6.38%. Earnings per share moved from 19 cents to $1.27 over this period, which is a compound annual growth rate of 23.5%. This is extremely impressive growth. For those who think banks don't grow, Huntington has grown faster than a lot of tech companies I know of. A consistent expansion in margins over the last decade definitely helped the bottom line. Moving forward, CFRA believes that Huntington will compound its earnings per share at an annual rate of 4% over the next 3 years. This would be a material slowdown compared to what the bank has been accustomed to. I'm not quite sure what has led CFRA to such a conservative forecast. It is interesting that they actually raised their price target on the stock by $2 after the TCF financial news was announced. CFRA also says this about Huntington, and I quote, "The bank's solid franchise in the Midwestern US generates low-cost core deposit funding, while its loan granularity is excellent with limited, large, single-name concentrations. Their conservative underwriting is evidenced by its reduced risk profile and sound asset quality," unquote. In my view, low interest rates act as the elephant in the room, and I think that this is partially what led Huntington to make their move on TCF Financial. I will say though that the banking business model is one of the oldest and most attractive out there. At the core of it, it's all about the float. That's the low cost, low risk source of capital that a bank builds up as a natural course of doing business. You take in at one rate and lend out at another rate. This spread can be incredibly profitable, but low interest rates are challenging. That said, low interest rates aren't new, and Huntington has been growing briskly anyway. With the TCF move expected to be so accretive, I think CFRA's view is overly cautious. But even if the bank does only grow at this mid-single digit rate, the dividend can also easily grow at a similar rate. And when paired with a near 5% yield, that's a lot to like for investors. Moving over to the balance sheet, Huntington has a rock-solid financial position. They have total assets of $109 billion against $97.2 billion in total liabilities. Credit ratings are as follows: A- S&P, A3 Moody's, and A- Fitch. Profitability for the bank is good, and I like that there's been a steady margin expansion in recent years. Over the last 5 years, the firm has averaged annual net margin of 23.81% and annual return on equity of 10.92%. Net interest margin is at 3.26% over the last year. This bank offers investors a lot to like. The yield is quite high, and the stock hasn't yet rebounded to its pre-pandemic levels. A large float is a competitive advantage for an entrenched bank, and the sticky nature of deposits means this competitive advantage is not easily lost once gained. The bank already has scale, with that scale set to grow meaningfully after the TCF Financial transaction closes. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. A lower for longer paradigm around interest rates is a major headwind for all banks. Banks are highly exposed to economic cycles, and the current cycle is fraught with uncertainty. Any residual effects from the pandemic and economic shutdowns could leave a lasting scar on the bank. If a long-term recession results from the pandemic, this will hurt the bank twice over. Less economic activity limits growth, while loan losses stress the balance sheet. There's also near-term execution risk with the TCF transaction. With these risks known, I still think this stock is a compelling long-term investment right now. The valuation makes it extra compelling, with the stock still 18% off of its 52-week high. The stock is trading hands for a price-to-earnings ratio of 17.6. That's higher than it really should be, as the reserves the bank took earlier in the year have reduced trailing 12 months earnings per share. Yet it's still lower than the broader market. Consider the price-to-cash flow ratio of 6.7 is markedly lower than its 3-year average of 9.0, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate and a long-term dividend growth rate of 5.5%. This dividend growth rate is on the low end of what I ordinarily account for. It's much lower than the company's long-term earnings per share growth rate and recent dividend growth rate. It's also not a lot higher than CFRA's near-term earnings per share growth forecast, which I see as extra conservative. Plus, Plus, there's the exciting TCF transaction, which boosts the combined enterprise. However, I'm being cautious here because we simply don't know what kind of lasting effects the pandemic will cause. I think Huntington could easily outpace this mark, but I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $18.09. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stock. Morningstar rates Huntington as a 3-star stock with a fair value estimate of $14. CFRA rates Huntington as a 3-star whole with a 12-month target price of $13. I came out high, which is surprising. Averaging the three numbers out gives us a final valuation of $15.03, which would indicate the stock is possibly 21% undervalued. Here's the bottom line, guys. Huntington Bancshares Incorporated is a high-quality business that's set to get even bigger and better with an exciting merger coming up. With a market-smashing yield of near 5%, double-digit dividend growth, almost a decade straight of dividend raises, and the potential that shares are 21% undervalued, this is an off-the-radar stock for dividend growth investors to strongly consider buying before it fully recovers.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.